My prediction is pain. The pain trade is higher. That's coming up on 3 minutes on Markets and Money. Markets last week rallied off of support, and the markets are positioned to move higher here, at least at the opening of this week. The pain trade right now seems to be higher as, again, we have a lot of short positioning in the markets. Negative sentiment is back. Positioning is at a very low level. This all provides that kind of catalyst for at least a counter trend rally in the markets. Now, there are some bullish indications that are now picking up here as well that does suggest that markets could move higher, at least here in the short term. But let's start out with some of the overall view of it right now. First of all, starting out, we do have a rising bullish trend line in the markets. We've been setting a pattern of higher lows as we've been rallying here since that July bottom. However, on the negative side, we do have a declining trend line at this point as well. So we are forming this kind of wedge in the market that runs right along the 200-day moving average. So again, that's going to be the real challenge here for the markets, at least in the short term. A rally to that declining trend line is the most logical right now, particularly that we are now getting a short-term buy signal in one of our very short-term indicators. Also, our oversold conditions are not back to overbought yet, so we still have a bit of room here in terms of fuel in the tank to get this market to move higher. But if this market does move higher towards that 200-day moving average, we're going to trigger our MACD buy signal as well. So this is going to kind of kick in multiple levels of bullish confirmation that will suggest that prices could move higher here. And if we do break out of this kind of consolidation wedge pattern the market is building, that is going to start to increase the odds that markets are going to move higher, at least here in the short term, particularly as we move into the end of the year. That's the bullish case. Now, we can certainly make plenty of bearish cases here. A break below this trend line for any reason whatsoever, that's certainly very bearish here. And markets really have not factored in what we're going to be looking at in terms of slower economic growth, slower earnings growth, and earnings recession potentially. Higher rates have not really impacted the markets yet. And Fed rate hikes are still continuing, even though they might slow down. They're still moving higher. Expectations right now for the Fed is to hike rates to over 4%. That has really not been priced in to the markets, valuations, etc. So there's certainly a bearish case to be made, but at least in the short term right now, there is a bullish case being built in the markets, this oversold kind of negative sentiment environment that could certainly push stocks up to around 4,100, 4,150. If we do break above 4,250, that will be a good indicator that we have put in a bottom to the markets, at least for the intermediate term, and that trade will continue to be higher. And as we move into the end of the year, obviously getting back into the seasonally strong period of the year as well. So there's certainly a bit of a bullish case to be made here. Manage the exposure here, still use rallies to reduce risk and rebalance portfolios. Once we get above 4,250, once we get above that 200-day moving average, then we can become a bit more bullish about our positioning at that point in time, if it happens. I'm your host, Lance Roberts, for 3 minutes on Markets and Money. See you back here tomorrow. Oh,
you sound more like a televangelist.
I know, right? My prediction. Hallelujah.